I'm Tyler Otto, and I am president of ThinkAccounting, the latest accounting service to hit the hospitality industry to deliver results and financial insights to you. And I'm so excited to walk you through today everything that we're going to put in place to help you drive the performance of your in-hotel, campground, glampground, or even side room hustle that you have if that's what your thing is. But today we're going to really talk about one of the biggest unsung heroes of the accounting industry, and that is accrual-based accounting. Yes, it's a cruel world out there, folks. Most business owners, when they get into running their hotel or inn, they just start managing their books by, hey, money comes in the bank account, expenses go out, and that's how I'm gonna track my financials. But there's a reason us number nerds have a job. It's because by doing the accounting properly, we can give our clients the ability to monitor metrics and statistics that will help them drive profit in their business. So today, I wanted to take some time and walk you through some of the key ways that you can leverage ThinkAccounting or just accrual-based accounting principles to save money and drive growth in your business. That being said, let's dive right in. So first off, let's talk about some of the benefits of accrual-based financials. First off, if you're on cash basis, it could be costing you thousands of dollars in taxes, right? Like most business owners, if you just spin up a side hustle tomorrow, driving Uber or selling something on Etsy, this is not a problem for you. But you didn't get into a side hustle. You got into the hospitality industry where there's a lot more complexities, and ultimately it could be draining money from your bank account by not getting this key component of your financials right. Secondly, accrual-based accounting, there's a intrinsic possibility for errors if you aren't doing it the right way or using a great PMS platform like ThinkReservations or using good, solid financial practices. Lastly, we can adjust our operations in real time by being able to monitor some key metrics, and I'm going to get into that at the end of this session today. So first off, let's talk taxes, right? I know a lot of you just fell asleep, but I assure you there's money in this at the end for you, so stay with me. First off, let's talk about a cash-based business, right? Most of us, we started our business, and let's say we have $385,000 in income we brought in this year. Now, a lot of businesses, maybe that these are reservations, advanced deposits for next year. So in November, December, you're booking guests for the following summer. Well, if that money comes in your bank account in November and December, you're gonna pay sales tax on it if you're recording on cash basis. Money comes in your bank account, you claim the sales tax, and you're gonna pay 28 grand-ish, depending on your city, state, county. And then you also have to pay income taxes on that amount at the end of the year. Now, we're assuming a 15% tax rate, could be higher, could be lower. Either way, the example is here that you're paying $86,000 in taxes in 2024 if that was the scenario. But we do accrual-based accounting. And one of the main premises of accrual-based accounting is we recognize revenue and expenses in the time period that the revenue is earned or the expenses are incurred. That was a really nerdy way of saying we should not be recording that revenue until our guests come and stay with us. So in the second scenario, we collected all this money in November and December, but we're not recording that $385,000 until they come and stay with us the following year. Well, guess what? We don't have to pay the sales taxes until several months later. That's already $28,000 that you get to sit on, earn the interest on, and maybe even redeploy as early investments into your property to have it ready for those guests when they come. You have the flexibility of sitting on that cash. The other beauty is you're not paying income tax now if you're filing your taxes on accrual basis because those advanced deposits are recognized the following year. That's $86,000 we just moved from one year to the next. So you're paying zero taxes on those advanced deposits, and then you get to pay them next year. That's up to $5,700, let's say, in interest that you could earn on that money just by letting it sit in your bank account and grow over that time. I mean, talk about free money in the couch cushion. If this isn't enough for you, I don't know what ever will be. So with that said, let's drive on to a few other benefits though, because with proper accounting and what we're doing over at ThinkAccounting, is we're going to implement and work with you on the uniform system of accounts for the lodging industry. Now, USALI, it's a book that you'll hear us reference a lot. If you want to fall asleep tonight, go read a few chapters. It'll put you out. It is better than NyQuil. But it is the industry standard for hotels up to 80 million a year, all the way down to small inns at 250,000 a year, and everything in between. And what it allows us to do is compare apples to apples between these two massively different operations. There are now standards in place where we can look at the analysis by different departments. So you may just have a rooms department putting the heads in beds and getting revenue off that, but you also may have a food and beverage division, maybe two. Maybe you have a marina on site, or a retail store, or an activity center. And it breaks out your financials in a way that we can monitor each revenue or service line in order to monitor its performance. And then we can even compare it against benchmark data, industry data standards. So we can look at how other operations that are similar to yours operate, and we can start looking at some of those key metrics and decide where can we push improvement or where can we maybe save some money. So, super excited because we're gonna walk through some of those examples on how we can actually implement this. And just so you're aware, that benchmarking data, as ThinkAccounting grows, we're hoping to have plenty of data insights to give you the more and more people that come on board, which is going to be a phenomenal benefit to all of our customers. So let's talk about some of the other foundational things we can put in place to help your business. One of the things that I think most business owners aren't aware of is a capitalization policy. As you start your hotel or inn, you get to decide what's your goal. Are you looking to maybe save on taxes, and your ultimate operational goal with your financials is to expense as much as possible, get your taxable income down, pay less to the government? Well, we can decide that anything under $2,500 is an expense, even if normally you consider it an asset and we have to do depreciation, which I know several of you are like, Tyler, I don't even know what depreciation is. Come join some other webinars, we'll talk about it. But for those of you that are nerding out with me, we can start expensing as much as possible under that $2,500 mark and start decreasing our net income and reduce our tax liability. Also, we can put in a policy that says, hey, we want to sell in the next couple years. Well, in that case, let's get all those expenses off the income statement, put them as assets, and we can make the business look more profitable and more valuable. Yes, it makes us owe a little bit more in taxes, but at the same point, this is all a legal way that we can make the business look more profitable and get you a higher rate of return when you go to sell. So again, these are just all those amazing practices we can put in place that will drive value for you once you decide what your goal in your business is. Now, last thing I want to talk about though are the metrics. And this is where I want to spend the majority of the time, because I mean, we could go any direction with building out a dashboard for you. As a wise philosopher once said, or philosophers, tell me what you want, what you really, really want. The Spice Girls got it right that we can pick our lane as to what we want to monitor and drive profit in first. So we're going to look at things like labor margins, and we're going to look at things like net profit margins. But to get there, we have to talk about why we need accrual-based accounting. You see, if we go back to a cash basis, you record the revenue when the money comes in your bank account. So let's say we had $300,000 that we collected for the upcoming summer, and it was all in March and April. And then we had our staff work with us, and over the next couple months, we recognize that expense. Well, you can see in this example, that doesn't really make a lot of sense to us. We didn't make $210,000 in March and then run a negative deficit in July, August, September. No, we want to recognize that revenue and that expense in the same time period so we can see how profitable each month is. And so now that we've done that, we can start looking at some of these metrics. One of my favorite metrics that we always start with every client is a simple one, and you might be like, Tyler, this is a softball? Like, you're starting way too elementary? I know, stick with me. We're gonna get to some of the cool stuff. But first off, many business owners only start looking at revenue. Now the problem with that is they'll be like, hey, like revenue's up, and then they look at their profit margin here in orange, or their profit. And they'll be like, yeah, revenue's gone up. As we get into September, October, profit's gone up, we're doing great. And a lot of times they leave it at that. But this is where we want to put one of our first metrics in place, which is just simply profit margin. How much of every dollar that we brought in revenue makes it to the bottom line? And if we look at that, we can see that our profit margin actually doesn't follow our revenue. We can see that throughout the year, in March and in October, those shoulder seasons, our profit margin was down. We were not driving most of our dollars to the bottom line. And so that's where net profit can ultimately lie to you. You need to see how efficient you are of using those dollars. And so in our graph on the right, we're breaking down and monitoring that profit margin over time. Well, profit margin, it's really what we call a smoke indicator, right? When there's smoke, there's fire. That tells me there's a problem somewhere. We should probably go look for it. So what are the two main issues we usually see that cause profit margin to go off the rails? And it's almost always one of two things in businesses like this. It's either labor or your cost of goods sold. Almost every business, that's what it comes down to. And for hotels, it might even be a little bit in the operating expenses, but let's dive in to what we should be looking for here. We were looking at one of the hotels we work with, and we saw that, labor goes up in the summer months. The owner was monitoring it, and they're like, yeah, that seems about right. It's a little bit more expensive to run the hotel. And they didn't see anything abnormal with this graph. Well, let's put it right next to the revenue that the rooms department was delivering. Again, the rooms department is just your heads in beds. Well, now we can see that labor doesn't really tend to always follow how much revenue they're generating. In fact, if we look at every labor dollar spent compared to a dollar brought in revenue, we can start to see that there are some crazy things going on with their labor margin. We can see that in the months of April and November, labor is through the roof compared to revenue coming in. And usually this screams to me a couple things. Maybe it's we don't have a good staffing model. Maybe year round, we are constantly having two people at the front desk. We're not flexing our housekeepers and calling some people off some days. We're not looking at, I could leave a couple rooms dirty for 2 days and have the housekeeper do them all in one day to be able to save on labor than have them come in every day. And usually scenarios like this, where those shoulder seasons, particularly for me, I'm from Utah, so ski season and summer are great, April and November are awful. In scenarios like this is a common issue we have, where we're not flexing our labor, we're not flexing our staff, and getting the most value out of our business. And so looking at these labor margins, it's a great way to start to identify why we're missing out on profit. Now, what else could be the issue here if it's not maybe a staffing one? Well, there's usually 3 things that lead to chaos when it comes to labor margin. It's overtime. People are just going into overtime. It's not approved. We haven't planned on it. And I'm not saying overtime is always bad, because it's not. Overtime, if it's planned and it's a good use case, can be a great tool for business owners to use in those very short seasons where you need extra labor. It could be overstaffing or understaffing, like in those examples I gave of having the same amount of people on site, regardless of if we're 10% occupancy or 90% occupancy. Or you could have an issue with wage theft. We had a hotel we worked with in Colorado where we started looking at this margin and noticed that it was consistently going up. Led the business owner to start reviewing security cameras and finding that one of their housekeepers was taking a 2-hour break every day in the middle of one of the alleys to just play on their phones. I assume Candy Crush, could be something else, but that's the joke I've committed to these days. So regardless, this is a great way to look into your financials and see that there might be something wrong and we got something we need to fix. But maybe it's not a labor issue. Maybe it's cost of goods sold. Now, I like to nitpick on those hotels and inns we work with that have a restaurant component as well, but this is also true for things like cost per occupied room or any guest supplies, guest amenities. Any of that is something we want to monitor as a percentage of revenue. And we working with one of our businesses, and we saw that food and beverage costs really went up in October, enough that the business owner was panicking, like, why are we spending $125,000 in food costs just in the restaurant alone during that time period? Well, that's not the whole story. We got to look at revenue next to that. And when we put the revenue next to it, they're like, oh, never mind, we're good. Revenue's going up at the same time at the end of the year as food costs are going up. Everything's fine. But No, that's not the whole story. You see, if we go back to doing our margins, which you've probably figured out by now, what percentage of every dollar we brought in revenue was spent on those COGS? Well, now we can see the true issue. In April and October, we're spending almost 30% more on food than we were during our operating seasons. This is actually a great way to point out that, hey, we need to look at what's going on. Maybe we had an inexperienced chef, or maybe we had new staff training. Maybe it was expected in October that they were closing down for the summer season and had to throw out a lot of waste. But now we know the time periods we need to look at. Now, again, this is why you need one of those examples, but I tend to also see there's three main culprits to why cost of sales are off. And it's usually either waste, whether it comes to the rooms division, whether it comes to a restaurant, it's usually just inefficient and waste. It could be spoilage of any sort of guest supplies or food, or we're back to theft. Again, worked with another hotel that while looking at these cost of goods sold, we noticed that things were off, particularly with proteins going out the door, that just something didn't add up. They started doing some investigating, found out that a couple staff members were selling racks of ribs out the back to friends and family. Hey, ugly surprise, but the accountants to the rescue were able to identify that there was a trend. So, great reason to start tracking some of these metrics in your business. Now, for the sake of time, I'm gonna hit you with a couple more I love, but you're probably overwhelmed. And so I'm gonna give you a few guidelines at the end of this. But for those of you that have started a business and you have the friends and family heavily involved, I want you monitoring your discount margin. Again, discount margin is just how much of every dollar that you brought in did you have in discounts to offset it? And so we'll work with customers to look at things like, what is their revenue per customer? Revenue, your average daily rate, right? Revenue per occupied room. Well, in this scenario where we look at a restaurant side of things, we can see that the revenue per customer started going down. Well, what could lead to that is we start looking at our discount margin, which is what percentage of every dollar came in, went out the door as a discount. And in scenarios like this, we always see that there's a family member, Uncle Jerry, let's call him. Uncle Jerry comes in and he sees that the business is his small little fiefdom where he can give out handouts to his friends because it's a family business. He knows the owner, he can do it. And this is where we can find where our business owners are missing out on tons of money because this was a real example. Discounts were going out the door that nearly doubled during the period that he was running the restaurant for this customer, but also we see this at the front desk. So I love to nitpick on these for some of our clients. Last up, let's talk cost per occupied room, because I know we talk cost of goods sold, but this also applies on the hotel division where we want to look at how much we're spending per occupied room. You should absolutely be tracking this metric because expenses alone don't tell you how you're performing. You need to look at how much you're spending compared to the occupied room nights. And if we look at this for one of the examples of our clients, we saw that, while expenses looked normal going into that November and December time period, the cost per occupied room nearly tripled. And that's where we need to identify, is there a theft issue? Is there an over-ordering? Maybe guest supplies or something else went up, utilities went up, I don't know, but we need to investigate and find out, do we need to increase our prices to offset this? Is it a labor issue that maybe, the state, we had a client in Arizona when minimum wage changed, it shot their costs through the roof and they had to adjust? I don't know, but this is where you're gonna find the smoke signals that are saying, hey, there's a fire somewhere, we need to go put it out and adjust. Now the thing is, we've only focused on the income statement, the P&L, right? The P&L is where accountants usually live and die, so much that I named my kids Porter and Luke and didn't even realize after the fact I named my kids P&L as an accountant. That's a problem. So what we also want to focus on is the balance sheet. The balance sheet is where we can see the cash health of our business, right? We give the BS a sniff test and make sure it's actually healthy. Well, for us, we have a saying in our firm, which is revenue is vanity, profit is sanity, but cash is king. You need money in your business and you should be monitoring how healthy your business is from a runway point of view for your cash in the bank. And so what we like to look at with our clients is a simple metric called working capital. Working capital is just how much you own in cash and receivables and other assets versus what you owe other people. And so we can look at what do you own? Bank accounts, receivables, anything that's not your assets, the building. And then we compare that to how much you owe, which usually this could be credit cards, short-term loans, lines of credit, or advanced deposits. People that have given you money and you're just sitting on it until they come and stay with you. Well, we had to do this for one of our clients, and when we start to look at it, they were super stoked because if we look at their current assets, they were sitting on, almost $600,000 in current assets at that time. But if we look at it next to their current liabilities, how much they were sitting in advanced deposits of other people's money, they actually went negative on this. And this is a huge concern. We actually like even a metric we call your cash, because we just want to look what's in your bank account versus what you owe other people or those advanced deposits. And it helps paint a very clear picture of, do you have potential exposure? We have one client here in this example where in June and July of 23, they were over $215,000 in the negative compared to advanced deposits they were sitting on. And they said it's not a problem because we have a no refund policy. Well, unfortunately, there are scenarios where everyone has a refund policy. I hate to break it to you. First off, we had one client outside Yellowstone that when the road to their property got washed away and people couldn't get to the property, you better believe there was a refund policy and people expected their money back. Or, I don't know, let's just say a crazy scenario like, let's say a disease breaks out and government shut down hotels and you can't stay, just hypotheticals. In those scenarios, you don't want to be left holding a giant obligation to give your money back to your customers. And so we always love to look at metrics like this to ensure that you have the cash on hand to cover any sort of mass refund you might have to do. But, in cases like this, let's say you have money elsewhere to cover it, that's fine outside of the business, but we want you looking at this. So make sure you look at your bank balances minus your advanced deposits, because that is the key to financial health. And by this point, you should be exhausted. I have thrown so much at you, so many ideas, and the one thing I don't want you to do is walk away from here and just be like, Tyler, I need to just go, use my Excel mastery and build the world's most amazing dashboard and monitor 600 metrics. Yes, you could do that, but if you're monitoring everything, then you're really not prioritizing anything. So you need to look at this and decide, what are we struggling with in our business? Maybe it is labor. Maybe it is cost of goods sold or cost per occupied room. Maybe it is a discount margin. Maybe it's one of hundreds other things. But I would say pick the 3 to 5 that are going to be the most impactful for you and your business to get started, and let's start monitoring those for the next 3 to 4 months. Let's get good financials in place so that you can make the adjustments in your business to drive profit. And if at any point you want help with any of this, come on over to us at ThinkAccounting. This is what we do. We want to enable you with the insights and just the visibility into your business so that you can secure the future of your hotel, inn, campground, glampground, or whatever it may be, and ultimately have a profitable business that you're proud of. Thanks, and look forward to talking to you soon.